If you earn a paycheck, you're the easiest person in the system to tax, period. There's no ambiguity, no negotiation. Your employer acts as a collection agent for the government, and the money is gone before you even touch it. That W-2 form you get is a perfect, clean record of every dollar you made through labor, and every dollar gets its cut taken. Wealth, real wealth, doesn't come from a W-2. It comes from assets, and assets play by a completely different set of rules. For the next 10 minutes, I'm going to explain why this happens, not with moral judgment or political spin, but with the cold, hard mechanics of a system that is working exactly as it was designed. Let's get one thing straight. The core problem isn't some secret loophole. The myth is that the rich have teams of lawyers finding hidden passages in a 1,000-page tax code. That's mostly a fantasy. The truth is far more straightforward, and frankly, more insulting. They're using the front door. The tax code is fundamentally built to treat two things differently: income and assets. Income is what you get for trading your time, your salary, your freelance check, your overtime pay. It's active. You did something, you got paid for it. And the system is designed to tax that transaction immediately and automatically. Assets are things you own. Stocks, real estate, a business, a piece of art. They have value, and that value can grow. But here's the critical distinction. You are not taxed on that growth while you own it. The appreciation is silent. This difference, the timing of when taxes due, is not a small detail. It is the entire game. Your salary is taxed the moment it's earned. An asset is taxed only when it's sold. And the wealthy have structured their entire financial lives around minimizing or even eliminating that moment of sale. So how do they do it? The strategy is so well known in financial circles, it has a name. It's simple, it's legal, and it's brutally effective. It's called buy, borrow, die. Let's walk through it with a clear example. No jargon, just numbers. First, buy. You purchase an appreciating asset. Let's say you buy a small commercial building for $200,000. You rent it out, you maintain it, and over 20 years, the neighborhood improves, inflation does its work, and the building is now worth $1 million. You have an $800,000 gain on paper. If you were paid that same $800,000 in salary over those 20 years, you would have paid income tax, Social Security, and Medicare on every single cent.
But on this asset, you've paid zero tax on that gain. Nothing. It just grew. Your salary gets taxed. Your asset appreciates. Next, borrow. Now you're older and you want to use that money. The average person's instinct is to sell the building. If you do that, you trigger a taxable event. You'll owe long-term capital gains tax on that $800,000 gain. Depending on your income and state, that could easily be a check for $150,000, maybe $200,000 written straight to the government. Wealthy individuals rarely sell their core assets. Instead, they borrow against them. You go to a bank and you say, "I have an asset worth $1 million. I'd like a loan." The bank will happily give you a line of credit for, say, $500,000 with the building as collateral. And here is the single most important sentence you will hear today. Loan proceeds are not income. Therefore, they are not taxable. You receive $500,000 in cash, tax-free. You can live on it, reinvest it, buy a boat, it doesn't matter. You got the money without selling the asset. Meanwhile, the $1 million building you still own continues to appreciate in value, likely faster than the low interest rate on your loan. You have turned your wealth into tax-free cash flow. Finally, die. This is the part that makes the strategy permanent. You live a long life using your tax-free loans. Eventually, you pass away. You still own the $1 million building and you still have that $500,000 loan. Your children inherit your estate. Under current law, they benefit from something called the step-up in basis. What this means is that for tax purposes, the asset's original cost basis, the $200,000 you paid for it, is wiped clean. It's erased from history. The basis is stepped up to its fair market value on the date of your death, $1 million. So your heirs can immediately sell that building for $1 million. They use half of that to pay back the $500,000 loan. The other $500,000 is theirs to keep. And the capital gains tax on that original $800,000 appreciation, it's zero. It completely vanished. The tax was legally eliminated from existence. This isn't a loophole. It's a feature of the tax code called estate planning. So why do you, the normal person, pay so much more? Because your financial life is the polar opposite of this strategy. You don't have a portfolio of appreciating assets to borrow against.
Your primary asset is your ability to work. And every time you leverage that ability by working harder, getting a promotion, taking a side job, you generate more taxable income. Your reward for more effort is a higher tax bill. The system you operate in punishes labor and rewards capital. When inflation hits, it's a triple whammy for you. The cost of living goes up, your wage might get a small bump, but that bump pushes you into a higher tax bracket. That's called bracket creep, so you keep even less of it. And the fixed dollar deductions you might get are worth less. For an asset owner, inflation often just increases the nominal value of their holdings, making their collateral stronger. You are on a treadmill. They are on an escalator. What does this mean for a regular person? This isn't about becoming a billionaire who never pays taxes. It's about understanding the rulebook so you can stop playing the game on the hardest difficulty setting. Small-scale versions of this exist for everyone. If you own a home and are paying down your mortgage, you are building equity in an appreciating asset. That's step one. If you contribute to a 401k or an index fund, you are buying assets that grow tax-deferred. The fundamental shift is to stop thinking of your salary as your wealth and start seeing it as the seed money to acquire assets. The advice you always hear, just earn more, is a trap. It keeps you focused on generating the most highly taxed form of money. Earning an extra $10,000 is good, but using that $10,000 to buy something that can grow on its own, shielded from immediate taxation, is playing a different game entirely. Let me leave you with some hard truths. Nobody is being overtaxed by accident. The system is functioning precisely as intended. It is designed to be funded by the consistent, predictable, and easily captured wages of the labor force. All of this information is public. The tax code, the strategies, the financial concepts, they aren't hidden in a vault. The system relies on one thing more than any other: financial illiteracy. It relies on the population being too busy working for a salary to learn the rules of capital. You don't need exotic loopholes or clever accountants to change your trajectory. You need assets and you need time. It's a slow, boring process. It's about discipline, not genius. It's about ownership. So when you see a headline about a billionaire paying a lower tax rate than their secretary, you know the truth. The question isn't why the rich pay less tax. That's a distraction that leads to outrage but no action. The real question is why you're only paid in ways that get taxed. The system isn't broken. You've just been taught to play a different game, and you're paying for both.